owners are in a unique situation when it comes to federal income taxes. S Corps are different from C Corps in that owners must have a reasonable salary to avoid having tax issues as an owner. It's Miss Tax on Track with another S Corp video. If you've missed any of the previous videos, do check out Tax on Track's IGTV to get caught up. Now, for today's topic, reasonable salary. What does that mean, and how can S Corp owners avoid issues when filing taxes? First off, what does reasonable salary even mean? It means the owner-employee must be paid wages, not simply receive distributions, payments on their personal expenses, or any loans from the company. The wage payments to the owner must be made first before any of the distributions are made, and it must be withhold FICA and federal income taxes from their pay, and the business must pay their share of the FICA taxes along with other employer taxes such as unemployment and workers' compensation. For example, Carol and John are 50-50 shareholders in an S Corp. They both work as employees in managing the day-to-day operations of the business. Their net profit last year was $250,000. They want to split the profits and take them as distributions so they can avoid self-employment tax. But since they work in the corporation, they must first take the reasonable salary. Keep in mind, the IRS can always change a distribution into paid wages because they were categorized incorrectly to them, causing the wages to be subject to FICA and federal income taxes for both the business and the owner, and they will have to pay employment taxes. This may cause penalties for underpayment of those employment taxes on both parties. So, how do you calculate reasonable salary? Well, to find a reasonable salary for an S Corp owner, consider how much you would have to pay if you hired someone to do the same job. The IRS guidelines suggest you look at the following factors to determine reasonable salaries for your corporate officers. It'll be training, experience, duties, responsibilities, the time and effort devoted to the business, and dividend history, just to name a few. Use comparable salaries to back up your salary figures. Your ability to prove that owner-employee salaries were reasonable will help keep you on the correct side of the IRS. It comes time, especially when it comes time for them to look over your company's tax returns. You don't want to have issues. Each year, when you're completing the income taxes forms for your S Corp, you have to report the corporate owner-employee's salaries, listing the salaries for each corporate owner, along with the information about their percentage of time that they devoted to the business and the percentage of stock ownership that they have in the business. S Corp taxes are a little bit complicated, so I strongly recommend getting help from a tax professional when you set the corporate owner's salaries. If you've learned anything from this video or found value, do comment, like, and share. Download the Jumping Jack Tax app to locate Tax on Track for further assistance, or you can just simply click the link in our bio to schedule a free consultation. Until next time, have a great day.